Welcome to the Weekly Juice Podcast, where we discuss all things real estate, personal finance, investing, entrepreneurship, and the many ways to achieve financial independence. We interview accomplished investors and entrepreneurs with the goal that their stories inspire you to take control of your financial future. Here to get your creative juices flowing, while also documenting their own personal investing journeys, are your hosts, Corey Jacobson and Ryan Bevilacqua.
Welcome back to the Weekly Juice. As always, it's your boys, Ryan and Corey. It's Wednesday. You know the vibes. You know what it is. We're back with another episode. Let's go!
He's feeling it today.
He's feeling it today. Today we had on special guest Brian Wagers. He's a real estate investor who specializes in multifamily syndications. He's located in Arkansas. One fun thing about Brian is he is a... What kind of lookalike, dude?
He looks like Matt Damon. Exactly
like Matt Damon.
Yeah.
It's hilarious.
For the first 10 minutes, you were just like staring, and then you're like, I think I got a chance to speak. Oh, yo, bro, you look like Matt Damon.
Absolutely no question besides, hey, have you anyone ever told you look like Matt Damon?
Definitely tune in on YouTube for it.
Yeah, dude. If you're like the Bourne trilogy, you'll be in for a treat today. But either way, he's an absolute beast. He has a portfolio of 66 units just by himself, and like small duplexes, small apartments, and single families. And then he has a massive portfolio that he is jumped in with other people on. He has a total personal portfolio bought and sold of $36.8 million, 869 units. So that's 25 deals. He has a JV ownership deal of 249 units, and in syndications, he's bought and sold over $1.75 million on 1,400 units in just 6 deals. He's just done a shitload of stuff on the syndication side.
Yeah, and I think that one of the cool parts of the episode is that he gave actually some pretty practical advice on like how he found these deals, like how he found it. You know, he was literally driving around, taking photos with his girlfriend, now wife. And, you know, he sent out 30 mailers, he got 2 calls, he closed on a deal. Like stuff that we talk about, you know, not too often about the actual how-tos, like in buying bigger, you know, properties like this. So he bought a single family home, and then his next purchase was a 12 unit. So guys, you can do this. He's 31 years old. Like he's given the blueprint here. This was a good episode.
Couldn't agree more. I think we should let Brian tell his own story, bring him in, and let's do it. All right, Brian, officially welcome to the Weekly Juice Podcast. Corey and I are so excited to have you on the show. And here's your official welcome. So thanks for coming on.
Appreciate it. It's good to talk to some like-minded individuals.
Absolutely, man. So if you could give our listeners a little brief background on yourself and then walk us through the story of how you got into real estate investing.
Yeah, so I am a multifamily syndicator. If we flash back, I'm born and raised in Cincinnati. I went to the University of Kentucky for college, got my economics degree there. Coming out of college, I wanted to be a financial advisor or a stockbroker. I really wanted to get involved in the financial realm. I started applying for a lot of financial positions, but no one would hire me because I was too young and didn't have a Rolodex. So jumped into the sales world there in Lexington. And I was doing really well in sales for, you know, I was in a sales job for about 3 years. I was maxing out my Roth IRA account, and I knew I had to do something outside of my active income. I liked what I was doing, but, you know, I was starting to become somewhat of a high income earner, and I knew I had to do something with my money besides just put it in a Roth IRA. So all roads led me to the stock market and real estate. I actually tried, I was first getting involved in the stock market. So I was trying to time stocks. I bought like a young pharmaceutical company, and then I bought a bunch of GoPro. And GoPro at the time was like $35. And it went to $5 really quick. They decided not to go into like the drone industry. They were making some decisions. I don't know what. You know, I thought it was a great product. It was on the up, but they made some decisions and it tanked. And I was like, man, all that was out of my control, you know, and it was a lot of me just like watching it go up and down. And I thought it would be a little bit more passive than what it was. And So that led me to real estate, and like a lot, like you just had Brandon Turner on. So that I was listening to a lot of what he was doing. They were kind of the authority in real estate. So I knew I wanted to get into real estate. So I started reading everything I could on real estate, and I bought a little single family home. My life savings at the time was like $25,000 I used for the down payment. I bought like a little $90,000 single family home, had the lease up myself. I managed it myself. The tenant was great. My mortgage was like $450. The guy paid $950 first of the month, every month. There was no like water bust at 3 a.m. or anything like that. It was going to take way too long to get where I wanted to go. I really wanted to get into real estate. I take a lot of action, I take action quickly. So I just knew the first step for me was to get that first single family home. And then, once I was getting in a groove there, I was like, this is taking way too long. If I do this, I'm going to buy a house a year, so all roads led me to commercial. I really like the idea of commercial real estate. It was like these big projects, these big properties. You usually are collaborating with more than one person, and you can go bigger. And I started really diving into the commercial real estate world. And this common theme was, what's one thing you would do differently in commercial real estate? And they all said, I wish I would have got started earlier. So I started taking really big action, and I read everything I could on multifamily real estate, so I understood the fundamentals of rental property investing, and I understood the scalability of commercial real estate. So everything made sense for me to get into multifamily. How it performed in 2008, I didn't obviously personally experience 2008, but we can go back and learn from people who did. And multifamily performed, flatlined when everything else was dropping. And I like the scalability of multifamily. So I dove into multifamily. I went to every seminar I could on multifamily. I started reading every book, and I got my first 12 unit while I still owned my single family. So I got a 12 unit and scaled that up, and got to around 400 units of just 12 unit here, 20 unit there, 79 unit, 82 unit, another 54 unit. So I built up a portfolio of 66 units where I'm 100% up. I used some seller financing. I used promissory note. I actually refinanced some of my earlier properties that I added a lot of value and to roll those into some more. And then there's other 350 or so. I joint ventured with some family members on those, where I was the partner running everything, and they were the equity on that. And
yeah, man, that's a pretty good. I want to stop you just because we got to talk about some of this progress that you made there, and like how you got to this point. Maybe just tell us where your portfolio is at now, and then we can kind of work backwards too. I think that's where you were getting to. Yeah, and from there, I'm now at about 6,000 units under ownership, so with a lot more partners. So I partnered up with a group called Elevate Commercial Investment Group. That's the name of our firm. And we now have 6,000 units in Northwest Arkansas and Dallas and Florida. We're closing on a deal in Florida a couple weeks. We did a deal in Columbia, South Carolina earlier this year. So got it. Yeah. So it sounds like what I think is pretty unique about your story is that, first of all, I like the going away from the stocks. We diversify into ETFs, but to have somebody else kind of control your whole destiny by investing in their company and not the decisions that you make, we found that a little bit tough. But in specifically the real estate, I think the majority of people will buy a single family, buy a duplex, buy a triplex, and they'll kind of work their way up in this residential space. And there's this thought that commercial is so much more complicated and so much more for like this really super savvy investor who's been doing it for 20 years. And you kind of broke that mold like pretty early, considering your second deal was a 12 unit, which is full commercial. So what do you think it was about your mindset that allowed you to jump from the 1 to the 12 with full confidence that you could do it?
Well, my whole understanding was that the property itself supports like I think the big thing for people maybe get worried about is they think you have to have millions of dollars yourself to take down these large, multifamily properties. But for one, banks look at these multifamily properties as businesses in themselves. So they're really underwriting the property before they're underwriting you. And two, they're not really concerned about where the down payment is coming from. Whereas, my single family property, they wanted to know how I earned that amount from. And when you're buying commercial, they're not scrutinizing every $100,000 that's coming in to complete the project. So I really like that aspect of, being able to partner up with other people. And it provides that scalability of being able to do that. You don't just take it down by yourself.
Sure. So talk to us about that 12 unit then, like being that you'd only bought a single family by yourself. What were your partnerships like on that? Maybe what was your equity in it? What was your role? Were you the operator? Did you just raise money from family and friends? Kind of give us some background, because I think there's a lot more people, including us. We're LPs in larger deals now, but there's this thought that, our personal portfolios are single family and duplexes. So like for us to get into the operational side of a bigger property, even though we're a smaller time, I know we can do it. You're living proof. So like, how did that work for you?
Yeah. So, I had some people that I thought were involved in real estate that were doing well in business. And one of them was my girlfriend's dad at the time, now my father-in-law. And, they had owned a bunch of single family free and clear. They went through 2008. They were super debt adverse. They didn't like debt. All their single family was free and clear. So I just provided the business plan. I had training from the seminars I went to. I had bought, an underwriting tool. So I just showed them best case scenario, worst case scenario on this property. And at the time, he was kind of hesitant actually on it. I had the proof of concept, but he just a promissory note. Instead of getting any equity on it, he just gave me a promissory note where I gave him like 10%. It was like, he was going to give me 100,000, 120,000, and I would return him like 140,000 or something like that within a couple of years.
Got it.
So that's how we structured that first one.
So it's just the two of you?
Yeah, just the two of me. Just the two of us. Yeah.
Okay. Cool.
I get an important question.
Yeah.
Probably the most important of the show.
Here we go.
Anyone ever tell you look like Matt Damon?
Yeah.
Snipe.
Yeah.
Love it.
The whole time, Rise over here thinking about this dude looks like Matt Damon.
Like, dude, this guy's a beast. I'm loving it. That's great. Sorry. Not to make you blush, dude.
Did you have Did you have a question?
I actually don't have a question.
Okay.
No. All right. That was my question.
Well, he does look like Matt Damon. I wasn't thinking that, and now I can't unthink it.
Wait,
so
what were you going to say?
I have gotten it before. Yeah.
You got it. Okay. Yeah. No.
Okay.
Okay.
Maybe more like the first Jason Bourne before he started.
Yes, dude. The young version. I like it. It's cool. Yeah. So if you're listening, you probably want to hit us on YouTube and check this guy out.
There we go. Get the plug.
So, all right. We talked about how you got kind of family involved too. Cause I was wondering, I guess the biggest question is like scalability, right? People can get to 1 to 10 units themselves with loans and things like that. But then at some point you got a JV and like join in with other people. That's the thought. I want to talk about the most daunting part for me, I think, in real estate is, and I think for a lot of people that maybe aren't numbers people, but you mentioned you had an underwriting tool that you picked up to like study and kind of like proof of concept. Can you talk about that and just like a little bit of the research you did beforehand before you had this whole elaborate business plan that you rolled out, and just kind of like the nuts and bolts so people, if they want to go take action on their own time, they can do so?
Yeah, for sure. So, I mentioned that when I was in real estate, I was like in the school of the bigger pocket school that a lot of, real estate guys are in, quote unquote, listening to their podcasts. And once I made the decision to zone in on multifamily, I was picking apart any guys that were going on. I was just listening to any guys they interviewed on multifamily. And then from there, I would go and see if they had their own platform or what they were doing, and there's a bunch of people out there doing it. And what I found was a guy named Michael Blanc. He's got a really good program. And I got his apartment buying course, and it came with like a sample deal underwriter. Now there's quite a bit of people who have underwriters. Actually, one of my partners, George Abreu, he actually has his own multifamily coaching now too. So, for me, it was really important to like see, I would go and see what these people who were talking about it, if they were, and teaching, if they were actually there doing deals. that was the main thing. Like, you hear about the gurus and everything like that, but I want to learn from someone who's also like putting out offerings as well. So that was a big factor for me.
Awesome. So it seems like you bought into like I guess a course, and then it kind of like they provided you with the tools to study and do that. I think that's great. Yeah. Can you take us through just in layman's terms, if you will, or that's probably like on an elementary level, like a syndication deal from A to Z? I mean, we've had a few people explain it to us, but I just think it's cool to talk about the difference between like a single family home compared to with the commercial real estate. Like, what are the differences? And then like in your process from like underwriting to getting under contract and then placing butts in seats, right? Like I guess if you will, like in the apartments. And then at the end of it, kind of like how the profits are divvied up and like, do people just get cash flow per month? What are your exit strategies? So I know it's a lot there, but just maybe like the steps through this thing.
Yeah, for sure. So syndication, you have your general partners and you have your limited partners. The general partners are the active managers who found the deal, who are running the deal, who put together the lending, who sign on the loan, who put together insurance, oversee property management. Sometimes that's in-house, oversee construction management. Sometimes that's in-house, oversee due diligence, exits, pretty much all the active side, where the limited partners are just the equity. They're silent equity partners in the deal. And usually you'll see the equity, you see anywhere from like 50-50 to like 90-10. Typically we structure it 70% goes to the investors and 30% to the general partnership team. And so they're getting 70% of all upside in the deal. So they own 70% of the entity. So we'll create an entity, an LLC, where they are limited partners. Even though they have a majority of stake, they're considered a limited partner. So they have no risk because ultimately they have no say in the operations, So if you're looking to be like really get involved in apartment and learn the ins and outs, you could technically get into a syndication and kind of see it from afar, but you're not going to have any say. So that's partly for your protection. And partly because we can't have 30 investors all saying, oh, we should raise rents to this, or, oh, we should market it that way. You can't have that many people controlling the deal or even having the experience to do that. So they're the limited partners. Typically, there's some sort of preferred return. So like you see like anywhere from 6% to 8%, where the investors, before there's any sort of split being made, those investors are getting paid that 6 to 8% on their money. And then there's the 70-30 split. And then from there, sometimes you see even waterfalls beyond that. Like we usually put in like 17 or 8. Once we hit 17 or 18%, once you're getting 17 to 18%, then we'll go to a 50-50. And then from there, and then some people will create further hurdles in that. So that's typically the structure between the limited partner and the general partner. And you were talking about like getting butts and seats, that's one of the main reasons I got into apartments, is because property management was built in. That single family I had, I had no issues. The guy was great, paid me on the first of the month, but I heard all the horror stories. And I knew that if I was going to scale, like that's not something I wanted to do. And these apartment complexes, property management is built into the business, where they actually perform better with property management, and the property management should pay for itself plus more on the right deal, where I can go work on getting more equity or finding more deals while they're doing that. I'm paying them 4% on a large apartment complex. So
cool. With that, I know property management's baked in, right? To when you run on the numbers and things. Have you had any experience having to boot out an existing property manager that's just like underperforming? And then can you maybe talk about the process of finding an excellent one? The reason I ask this too is semi-selfishly, and I know it's completely different, or it definitely does differ a little bit, but we've hired a property manager that has had amazing reviews for our small single family portfolio. And they're great. They're like the customer service aspect is great. However, it eats up a lot of our cash flow. So I'm just wondering how this plays into the multifamily game and just what the difference is, because I feel like the property manager truly can make or break your biz.
I can give an example there, Brian, before you go in. Like, so when Rye says they're good, because they communicate well, like the the management aspect of it, like they're always sending contractors to the property within a timely manner. But part of the problem is that every time a tenant needs something, they're sent, like there's no evaluation of what the issue is, right? So we're getting, somebody's going, it's automatically $250 no matter what, right? Somebody goes out there. And then the fixes that are happening are like, are they necessary? Or are they not necessary? We don't really have a say unless it goes to over like $600-700, in which case we see all those invoices. So, you know, you would think like maybe if there's only one a month, that's $200-300-400. It's not a big deal. But if there's like 5 or 6, you're like, okay, $2,000 just went down the drain this month. And they're all small fixes that the tenant just, you know, wanted to happen, but may not be necessary. So I just to give people some context of what we mean by like all our cash flow was going out the door. I'm sure it's different on the multifamily and commercial level. Maybe you could kind of elaborate there.
I mean, it's definitely similar. I mean, you want to have like people think just because we have property manager, it's definitely active. You have to manage those property there. You have to oversee them and make sure they're not charging. And to your earlier question, yeah, we have had to fire property managers and put new property management in place. I did it on my personal portfolio, and we've done it on some of the larger syndications. You know, I had a property manager. It was like I would go through these reports, and I'm seeing charges for copy paper, like candy for the office, and before you know it, your expense ratio is up to like 58% on the property. You know, when you're hoping to get it closer to 50 or under that. So it's definitely like on the active managers to be making sure like you're catching those too. Like if we're sending a plumber out there every time that there's a fix, you know, that can add up, you know. So whether the great thing about property management is you have these maintenance tech that you have a 100-unit portfolio where it pays to have that maintenance guy, where you're just paying the hourly maintenance or the salary of him versus paying a specialist to go out there every time. So
Brian, at what point do you think that actually becomes possible though? Is it 100 units, like in terms of having somebody full time? Because that I think is a huge difference there. Is the 100-unit number a number to that brings in enough revenue to pay somebody full time, like to be on site?
I was joint ventured on one with just my father-in-law and I, and we had one on an 82-unit. I think you want to be careful with rules of thumbs, you know, like 100-unit is a good rule of thumb, I would say. But I mean, if the income is higher on the property and if the property supports it, you know, 82-unit might be able to make more sense. And especially with the value add properties where you're having more 1980 and older properties, they're going to have a lot more maintenance issues than an A-class deal, you know, where if you only have like if you have the 50-unit 2020 build, then probably don't really necessarily need a maintenance tech on site.
Cool. I got one for you because you keep mentioning your father-in-law and it brings to mind like raising private capital to me. And I think that's that's half the battle in this thing. So yeah. I think there's a lot of us out there that whether you have money or not, you know someone that has a lot of money, and people that are always looking to invest, right? Everyone's listening to, I don't know, CNN, they're talking money talks, like all this stuff. And they're like, hey, real estate, I want to get into real estate, but I have no clue, right? And there are avenues like syndications for people to get involved in. So for us, we're kind of at the next chapter of our book here, and we're getting into syndications, right? And we are going to be tasked with like raising private capital. And some of the things is like, we're not going to be the operator on some of these deals. So for me, I'm kind of looking for, at what point do I start bringing people in and saying, hey, listen, I know you have the money. You've been asking for a deal. Here's one that I have. So for us right now, we have a couple of deals going on and that we are involved in, and we've raised a little bit of capital, but not a massive deal like a multifamily syndication, right? Where it's like, hey, you got to raise $1 million. And if I go to like family members or people that I'm really close with, I want to treat their money as if it's like more important than mine, right? And so I want to make sure 100% that the deal is going to be successful, but I can't do that if I'm not the operator myself, because that's just not that's not our skill set. So I'm wondering if you have any advice for that kind of scenario. I know it's a little bit not as cookie cutter because it's like you're raising money for someone else potentially, but yeah, just your thoughts because you've been in the game for a while.
Yeah, for me, I wanted to like prove the concept myself first. Like that's why I got into the smaller deals too. You know, I was doing the single family. Okay, I was able to do this successfully. I was able to have a good return. You know, then I did the 12 units with just my father-in-law, you know, that I've mentioned a couple of times. So I proved the concept there. I knew that like, if for some reason, like the deal failed, like I would work my ass off just to pay him back, or I would like go pick up another job just to like pay him back. But then I started proving that concept of working with him. And I knew that, that I would cap out at that point, cap out on equity from family at some point. So I kind of foreshadowed that, and I started to talk about what I was doing. I mean, you guys are doing it right now. You're talking a lot about what you're doing. So, I started to let people know I'm interested in real estate and what I'm doing, and I have this proof of concept. So it wasn't like, hey, hey, here's this 250 unit apartment complex. You want to throw 100K in? It was like, this is what I've been doing, and this is where I'm going with it. And then as far as the operators go, I wanted to, that's why I partnered up with Elevate. I saw what they would do. They were super vocal on social media. I saw George on site, like on these properties and everything. I knew I can see like cracks in foundation, but doing due diligence on a 400 unit apartment complex, that's a whole nother beast. I wouldn't be able to, if I took that down myself, I would have no idea to like what to actually look for, so I felt comfortable with them having an in-house construction team. I saw they were at like 3,000 units before I partnered on with them too. So I was like, okay, they have some sort of proof of concept. So if you're raising capital for someone else, I would see what their track record is. How active are they in the space? Have they been active for a while? Are they currently active? Not like they were a while ago and now they are. What have their past exits look like? What are some of the recent deals they've done? What does their investor communication look like? You're kind of underwriting the operators themselves, as well. So that way you can go to your friends and family. It's like, hey, I understand real estate and I understand the power of multifamily, or I understand the power of syndication, but I'm also partnering up with these guys who have been doing this for a while, and they have these advantages in these markets. And that's why I feel comfortable with them. And when I was, because I was able to do those smaller deals, I built up sizable equity. I netted like a 7-figure net on on 66 of those units outside of all the other general partners. So then I was in a position where I'm in a position, I'm investing alongside my investors too. So I'm putting in in each one of these deals that I'm raising capital on, I'm investing my own money in it too, as an LP too. So that spoke to my investors too. But I think it's making sure you're working with the right operators, making sure you understand the market that they're investing in, making sure you understand the business plan, really diving in from there and talking about what you're doing to your friends and family.
Yeah. I mean, I think that's great advice. I really appreciate it. I kind of want to talk about, we've had a lot of people on the show that have talked about, well, I took down a 36 unit, I took down a 12 unit, I took down a 60 unit. And like, to throw that out there, I think the question that I would have if I'm like getting into this space where I feel like I can take on that next, like, how are you finding these deals? Like, what is your strategy? Is it as simple as building a relationship with a really good broker, staying connected to them, being ready to pull the trigger? Is it certain sites that you're using? Like, what's the way that you're finding these bigger deals? Because the MLS, as most people know, is like, you're not going to find them there. So where do you find them? Is it off market? Just give us.
I can tell you where I found my deals, and it's changed a lot the past 6 years, as it's gotten more competitive. That first 12 unit was on the MLS. I had set up realtor notifications of multifamily in my area, and that 12 unit was on the market. And I reached out to the broker. I was like over there underwriting the deal. And by the time I had convinced family to invest with me, the guy said, oh, it's already tied up. But I started following the broker that had it, and he listed it back on his website before he put it back out on the MLS. And I was like, hey, is this property still available? Like, I have that. I'm ready. He's like, yeah, their financing fell out. So I was like, I'll go meet you at the property right now and let's get it back. I'll make an offer same as that. I'll match their offer. And so we rolled from there. So that's awesome. I got 120 unit from Driving for Dollars. My girlfriend, who's now my wife, she would drive me around crappy looking apartments in there. We would go around these like dilapidated looking apartments that were distressed, and she would drive and I would take pictures of the apartment and write down the address, and then go on the county assessor website and look up the owners of the website or owners of the property. And I would send them a picture of their apartment and say, hey, I bought a 12 unit pretty close to here, and I'm buying more apartment complexes in the area. I wouldn't charge you a broker fee. I could even offer you seller financing. I pitched I can even offer you seller financing. So you save on taxes, and you don't have a big capital gains. And I sent out about 30 of those, 2 callbacks. One wanted way too much money, and the other, we ended up doing a deal where he seller financed it. So that was a way. And then I had these from there. I started making connections with more commercial brokers now that I had a track record. And I was like, hey, I got this 12 unit and 20 unit, and just started networking with commercial brokers. And from there, that was my source of deals was commercial brokers. And now that is our main source of deals. I don't do that much with Elevate as far as sourcing the deals. We have a guy that's out there calling brokers and meeting with brokers. He's even doing some text campaign. So finding owners and sending them text messages. He's been doing that.
Very cool.
Some people do direct mail still. And I know that can be a consistent long process. We haven't done that recently, but it's definitely another method.
It's great. I think it's important just to talk about that. I love the story of your former girlfriend, now wife, driving you around, you're taking pictures. You got to get gritty, and that's part of your story, right? Yeah. That's made you who you are today as an investor. I think it's amazing. So that's where the real wealth is made, right? It's in those days where you're grinding and you put all the work in, and then it'll come back tenfold down the line, right? It's you're just callousing yourself and sharpening your axe, if you will. But I want to talk about it seems like the relationships with the brokers. Are you an agent yourself? Did you end up getting your license to help get on the MLS, or and then to parlay off that, what is your role specifically with Elevate these days? I know you're a partner in a bunch of deals, but how are you helping them guide their ship?
Yeah. So for me, I remember that was a big question. I think it is too, for people who are looking to get active in real estate. Should I get my license, save on brokerage fee? But I know there's something with it being a realtor. You have to disclose that you're the buyer of the property. You have to disclose more than you really need to when you're making offers. So for me, that was just being more transactional too. That was just more if I got a realtor license, I'm kind of getting on, I guess it would be an advantage to buying the properties. But for me, no, I didn't get my realtor's license. I knew that the 3 to 6%, that's their bread and butter. They can do the cold calling. They can uncover the leads. I will focus on the other areas of business, and I will let them handle that. And, I believe in the value of the team. So, commercial broker, I was more than happy to pay them their finder's fee or whatever. So I didn't decide to get one, and we utilize commercial brokers now more than ever.
Got it. Cool. It reminds me of, it's funny. There's an 8-unit property literally 1 block away, maybe 2 blocks away from where I live. And I've driven by it, I don't know, 1,000 times. And it's I live in a B+ area. It's a nice area. A lot of young families, college town-ish, close by, a bunch of colleges close by. I know this thing would kill, but it just looks like a random brick building. It's so plain. I know that this thing could be renting out for, I looked up the rents. They're $800 for a 1-bed. And here you can get 1,500 or 1,600. So it's something that I've just been toying with and thinking about. But the fact that you were able to go out and make, 30, approaches, get 2 to call you and 1 close, that's pretty good. That's a better ratio than you would ever get. It's normally 1% calls you back, right? So that's awesome.
Yeah, people do a lot of people are spending thousands and thousands of dollars on monthly marketing. I just zoned in on that area, but yeah, marketing can get super expensive, and especially when you're outsourcing it. But I think the outsourcing part, it can get I get mail all the time for some of my properties, hey, I want to buy it, but there's misspellings on there. They don't even address the right name and stuff like that. So I think, for me, having that personal touch might have helped a little bit with it. It was a little extra work, but you should. And by the way, why don't you have you looked at the owners? Why don't you try to contact that guy?
The only reason is just because I don't have any money left anymore. No, but I I think we could I could probably figure out the financing, but
Wait, what did he say? What did he say?
I said, why doesn't he just you dove in and know what the market rents for that? You know what the rents are at the property. Why don't we, or you look up, go to the county assessor website, look up the owner who owns that and hit him up. Is what I was saying. Like, he's driven by this property. He's obviously been thinking about it. Why not?
I think
you can find the money, dude.
Yeah, no, and that's the thing. Sure. Like now I'm gonna be tasked. With doing this after the episode.
Brian's gonna be pinging you, dude. Did you get the property yet?
Yeah, the thing is like I know it could kill. So it's something that I've always wanted to own a bigger property around where I live. So I mean, it definitely can't hurt.
Too late, dude. I'm gonna call. Oh wait, we're gonna partner anyways.
Oh yeah,
that's great.
We'll find the money.
We will find the money. Well, to this point, it's a good part of the conversation I want to talk to you about, Bri, is you're skilled in negotiating deals. I think one of the biggest skills you can polish, if you will, or I don't know, enhance, is the art of negotiating deals and having the conversations with people and piecing these deals together. I think a lot of people always ask the question, where are you finding these deals? A lot of people are making these deals. They're not simply finding them, and it's having the knowledge and the skill sets to be able to navigate the conversations, but also be good with the numbers and be able to morph this into a benefit for the person that's selling it. So can you talk to maybe some resources or books, whatever it is that people can go kind of outsource and figure out how they can become better at negotiating deals and having these conversations? Because I think that's what's lacking and not talked about enough.
I think people aren't very good at, I don't know if they just are afraid or they're not good at sales. I think getting sales books is going to be helpful. Like, Grant Cardone says some wild stuff, but he is very good at work ethic and sales. And so the 10X rule would always, I like that one. I like Dale Carnegie, How to Win Friends and Influence People.
Great book.
Think and Grow Rich, not necessarily sales book, but
Never Split the Difference by Chris Voss. Have you read that one?
I've heard some of that. That's a good one. The Little Red Book of Selling, but I forget who wrote that one.
Oh yeah, I've seen that cover. Yep. Yeah. I need to read that. I need to read or reread Never Split the Difference. I think that's a good point for us.
That's a good one too. But I thought, like, when I read that, I wasn't ready to read it. Like, I wasn't ready to implement, but I'm going to go back and read it again because it is. And you mentioned Grant Cardone. Like, the only reason I used to not like Grant Cardone, the reason is because, like, if you'd be like, oh, like, what do you make a year? And he's like, you're like 300 grand. He's like, oh, you have no money. It's like, what?
Pathetic.
Yeah. I'm like, dude, all right.
Like, don't buy a single family home. It's like, well, my single family home just netted me 150,000 while I was like, I'm living in it. It's like, what?
I think his point is and it works, is to get people to think bigger than they think that they can think. And that was what struck me. I used to not like him. And now, I mean, I consume his content just because he's so big in the space. But a lot of what he's saying is true. Like the 10X rule, like it's thinking bigger than you think you can accomplish will actually help you land among that space. So
it's your fishbowl tactic that you're talking about.
Yeah, the fishbowl, like, you'll grow to the area that your environment allows. And I think that's so kudos to him, because although he may be brash and come off kind of like just like a dick, like he really does have the tools and knowledge to get other people to his level. So I'm glad we brought him up. Go ahead.
Yeah, I got one. So I just don't want to forget about
for the negotiation. Communication is 100% what you need to do. And when you're talking to brokers and when you're talking to these buyers, you need to respond to them right away. Real estate is a slow moving pace, but you don't want anyone waiting on you. It's the same approach I have with my investors now. They have a question for me, no matter what time, I'm replying to them right away, whether I have an answer or not. So when you're getting a deal, you just work this hard to get it. Let them know why it works for you, why it doesn't work for you, and what price you would need to be at to make it work. Like they're sending you this deal in good faith. Don't just eat crickets or like take a couple weeks. It really doesn't take that long to analyze a deal or like, here are my first thoughts on it. Here's where I think I need to be at. So I would really, like, for me, speed has really worked as far as and communication.
One of the cool things about that, Brian, is you never know what somebody else wants in the deal. Like, and that's why there's some people that throw out lowball offers and like, why would you do that? Or this, that, and the third. But like, if the person you're purchasing from owns a property free and clear, and it's been a headache to them and they don't know how to manage it properly, like you have no idea what price they're looking for is to get out of the deal or to help them. Just maybe they're like, you know what, I need $1 million to retire. And you can buy a 20 unit for that price, even though it's worth 1.5. Whatever it is, like just the motivation behind some of the sellers, I would tell people to not overestimate or underestimate it. Just try to do what's right for you in a deal, and it may work out. So
having justification behind, 100%, and like justifying your like this is what this is where I came at. Not like you want 1.5, I want to be at 1. Here's why 1 works for me, and here's what I plan on doing with the property. This is what I think the market is, like having a little bit more than just a number behind it is going to, I think, go a long way for you.
Cool. One other thing I want to touch on, and it is the LLC that people sign into, right? I think it's part of the process of syndications that isn't really touched on, but basically all the investors sign in with the managing partners and LPs come in, right? And they're the silent guys, but you're all on one LLC and it's divvied up. Can you talk about, like, are there monthly meetings that you guys have like on Zoom to talk to investors, like keep them up to date with the project, right? And then also talking about exit strategies, or is it just a newsletter? Just communication to the LPs. I'm curious on what you see as the most efficient and beneficiary to both sides.
Yeah, the document's got a private placement memorandum. So you'll definitely want to read that and make sure everything is in there. Even maybe have an attorney look at it. But for investors, a lot of the communication is upfront. Like they're wanting to know the deal assumptions, the market assumptions, what we're projecting to take over the property at, what's going on with that certain market. And then as far as from there, the communication is monthly. We send out monthly updates on the property. Here's what we project, where we projected we'd be at right now. Here's where we're actually at. Here's some photos of the property. Here's what we're doing on the property. Us personally, we do investor tours too. Like this month, we're going to be having an investor tour in Dallas on one of our properties and Houston on one of our properties. So we're pretty open book. Some of my investors will ask, hey, what's going on with it? We were projecting to be at 98% occupancy. We're at 95% occupancy. Some I don't hear at all. They're just like, here, take $500,000 and let me know when you have the K1 for me or when you expect distributions. And then some people are like I said, like fine tuning, so that those are fine. You get a lot in between, but we send out monthly updates on how the property is performing. And then I'm open to discussion 24/7 outside of that. Sometimes people ask other questions on that, but in the beginning, it's a lot of upfront. We'll do webinars on the property, kind of invite people to take a look at the underwriting.
That's exciting. So thanks for the breakdown. It was more thorough than I expected. So
cool. I know you've built your kind of way up to this point now, and you mentioned how many units you have. What is your current buy box? Like, what do you look for now or in the future for deals? Because maybe there are people that are interested in potentially being an LP or partnering in some way. What's like your bread and butter going forward?
Yeah, so we've gotten a lot more bullish on A-class properties when we can buy direct. Like 6 years ago, I would say A-class, that's where the private institutions, they just park their money and let it set it and forget it. That's just like a sexy looking apartment. The returns aren't there. But the past couple of years, our A-class properties have performed super well. And, there's a niche for us when we can buy directly from the developer. If we're the next in line after the developer, then we'll absolutely take a look. The developers are builders. They're not operators, no offense. They're really good at what they do, but not necessarily optimizing the apartment. So they have high expenses. They're spending hundreds of $1,000s on marketing just to get it to 80 to 90% lease up so they can exit and go build the next one. So they can cash out of their high interest construction loan and go build the next deal, so they're not really pushing market rents. They're giving away free iPads. They have all these marketing where we can go in, stabilize expenses and push market rents. and where we have this nice long asset where we're at a lower expense ratio, we can optimize that, and we can in turn sell that to a institution where it's turnkey for them, where we have some more end buyers. But that's not to say we're still buying value add apartments. We'll still look at those. But cap rates, a lot of people are looking to get into the multifamily space. So cap rates have compressed. So if I can buy a 5 cap on a C class deal and a 5 cap on an A class deal, I'm going to go with the A class every time. So, but there's still value add apartment deals to be out there. We have in-house construction, so we can control that aspect. So we like the value add deals. Texas, Northwest Arkansas, high growth states, Sunbelt states, Florida, we love. So does the rest of the country. So those deals are far and few between, but most of the team is in Dallas. So we like Dallas a lot.
Cool.
We're looking at other markets too.
What would you say to somebody who says, that's all sounds great, Brian, but we're in a recession, or we're about to be in a recession, and A class is going to get hit the hardest. And everything that happened in 2008 is going to happen again, which, by the way, I don't believe at all, but I'm just curious about what you're hearing, because typically in a recession, class would likely get hurt the worst. Maybe you see differently. So what's your take on what you're hearing out there in the market?
Yeah, so we're in a totally different market than we were in 2008, where there's predatory lending, and now we're just looking at interest rates going up, inflation, Sleepy Joe's out here doing whatever he wants to with the country. So we're giving money to Ukraine. We're deploying 87,000 IRS agents. Not to get too political, but it's a different environment than it was in 2008. So there's still a shortage of housing. There's a huge shortage of housing across the U.S. And these A-class apartments are places where people that don't necessarily have the money to go buy a $500,000 home, they want a nice place to live. Just because they don't have enough money for their dream home, they're living in these nicer communities. So we've seen them perform well in the pandemic, the last quote unquote kind of recession, where they performed well, where it was a different market than 2008. So you have these high income earners that aren't going to be as affected by the recession as someone that's might get laid off from Walmart or something like that, so they're in a more better position to wait that out before they buy a home. So
I did ask you about, Brian, your, what you're looking for now, but more specifically, what are your future goals with your business? Are you looking to do more LPs, more general partner deals? You mentioned earlier in the show that you're 31. So it's wild to see how much you've accomplished already. What do the next 10 years look like for you?
Yeah, like for me, it's to help elevate from 6,000 units to 10,000 units. And my specific role in that is placing capital into these multifamily syndications. So that's my own capital. And then whoever I meet along the way, that's, busy professional, busy entrepreneur, that their money is better spent going open up a couple more karate shops or going open another couple, businesses than it is going to try and find and underwrite deals. Their dollar per hour is so much higher on their main income that it doesn't make sense for them to go chase down real estate. But they know that they can invest in real estate, get the tax benefits. So it's talking to more entrepreneurs and talking to more busy professionals that want to get involved in real estate. And I'm looking to place, I don't know, $5 to $10 million of private equity a month is my main goal, for 2023. I'm looking ahead for 2023 and trying to place that into multifamily throughout the year. So would like to be doing a deal a month, by 2023.
Love it.
And, continuing to grow my net worth and my investors' net worth.
Cool. Sounds like a good plan to me. We love that stuff. So it looks like we made it to the second to last segment of our show, the Core Four. Maybe get to know you a little bit more personally here, kind of what makes you tick. The first question is, what is your favorite business or real estate investing book?
Business and real. I like we talked about a couple good books. If you guys go back and listen to that, but The Compound Effect is a really good one. just the whole principle of like compounding and discipline, like self-discipline, and how it affects your personal life, your financial well-being, and your physical well-being. So
Darren Hardy, the compound effect, jumpstart your income, your life, your success. So I actually don't know if I've heard of that book. I've heard of Darren Hardy, but I mean, every book that's mentioned on here, I'm like, gotta go read, and then I just don't. So
read a couple pages and then get a new book, and then it's
pretty much.
That's what happens to me, dude. It's so annoying.
Yeah.
I'll get halfway through it. I'm like, oh man, here's another one. This was so interesting, and I go through that one, then one half or listen to on Audible, and I just bounce back and forth.
Yeah,
it's tough sometimes.
Yeah, it's called 2022, man. Can't have the attention span to read a full book. You just got TikTok. Right. So,
dude, I don't use TikTok, to be honest.
Yeah, but I'm more meant like the educational stuff, like the 1 minute, the 5 minute videos, the YouTube. Yeah, like the more, like that's how I like podcasting because I love conversations. Like books, when somebody's talking to me, it's like when you hear the audio, it's like you don't have any interaction. So I like the podcast, but that's a great recommendation. I actually haven't heard of that book, but like I said, I've heard of the author. So question 2.
Cool. Question 2. This is going to be probably scaled a little bit for you, but interested to see how you'd answer it. If we gave you an additional $50,000, so a check for 50 grand today, tax-free, just us to you, how would you invest it, spend it, like divvy up the pie? Maybe it goes to one thing, maybe it goes to multiple, but how would you do that? How would you use it and why?
Yeah, I would put it straight into multifamily syndication. But it depends where, me personally, where I'm at right now, 50,000, I would just put into another syndication. But if you're just getting started, I would probably like try to figure out how I could get that 50,000 to $100,000, like, am I spending $10,000 on education or like depends what area of real estate you want to get into. I think 50,000 is a sizable amount, but it's really about how can I get that to 100,000. For me, probably about 80% of my personal net worth is in multifamily real estate. I do have about 20% in Roth IRA, stock market, a little bit in crypto, like a little bit like a dollar cost averaging goes into that, but way less than that. But. So
interesting. I guess I'll ask you about this is you say Roth, you mentioned your Roth IRA a bunch. There's a threshold if you make over, I think it's like, I don't know, $150,000 and then like 208 or something like that if you're married. So I assume you're over that cap. Are you just doing a backdoor Roth every year, just $6,000 at the end of the year?
Yeah, it's like $20,000. I think it was like $20,000 is my max. I'd have to go back and look, but I think $20,000 a year is a max contribution. So I have that's built up. I started that like 7 years ago, so it's built up a little bit. But
is it a Roth 401k maybe?
Yeah, Roth 401k.
There you go. Yep, I got it. Yeah. Cool.
Ryan loves the Roths.
I love the Roths, dude.
Yeah. Cool.
Yeah, so question. Set up my wife one soon too. But nice. I'm so bullish on multifamily. Mr. Wonderful wouldn't approve of that. He'd say get a little bit more diversified, but I diversify across multifamily holdings. So I have a little bit in Dallas, a little bit in Georgia, South Carolina, so that's kind of my way of diversifying.
I think you're doing all right. You'd probably survive without a 401k, but it is good to diversify. I agree with that. And that's why we have some e-commerce and we invest in our own 401ks and YouTube channel, automation. Amazon store we have. And then we also have, just like a brokerage. So like we do it too. It's just a lot less money than we're putting into real estate. So it's to each their own. So cool. Question number 3. What has been your biggest mistake in your real estate investing journey and how have you learned from it?
I probably should have started you guys talk about raising capital and me raising capital. I should have been talking more about what I was doing earlier on, like 6 years ago when I was first getting started. I didn't really start getting vocal about it for the past 2 years. So I think I would have been able to bring on more people along the way. So letting more people know, like not being shy about like getting involved in real estate when I was first getting involved.
Cool. easy plug for you or easy play for you here is just get on more podcasts, man. Your story will get out there, and then people will know that you have deals ready to go. They just need to bring the cash, call it a day. So love that. All right. Question 4 of the core 4 is, what do you want your legacy to be? So what gets you out of bed every morning to do what you do? What's your why to the reason why you do what you do?
Yeah. So for me, like, I always wanted to look back. Like, I don't have any kids right now, but like my grandpa, like he had his own heating and air conditioning company for like 50 years. And like, he built this company up from scratch to a sizable amount. And like, I want to build a business that I can provide my future kids, and that will be providing for my kids' future kids, and to be able to, do the same for other investors as well. So, just foreshadowing that future family and really building that legacy.
Incredible. Love that.
Love it, man. Brian, this is the last segment of the show, which is called what? The Last Drop. Almost forgot it. So this segment, we're asking you if you were able to go back in time, let's say to your 18-year-old self, and talk to 18-year-old Brian, what advice would you give him and why?
Buy every piece of real estate you can, while you're 18. Besides that, I had a pretty good trajectory. Like I try not to live with too many regrets, so it's kind of hard to go back and say I would do anything different, because everything I've done has led me to this point right here, talking to you guys, and my portfolio where it's at, and, the company. So, I would say stay positive and, always outwork the person next to you. That's kind of what's led me to where I'm at.
Hell yeah. I love that. It's really good advice. Yeah.
So first of all, thanks so much for coming on the show. We really appreciate having you on. It's awesome to talk to somebody who's a few levels ahead of, maybe more than a few, but levels ahead of us. And just, it helps us selfishly level up our game. And I hope people got some value out of this episode. I know they did, but what's the best way for people to get in touch with you? Let's say they want to network, maybe they want to go into a deal with you, or they just want to learn more about what you're doing. Yeah.
So I'm on all the social media. So if you just look up Brian Wagers on Instagram, Facebook, YouTube, or LinkedIn, whatever one is too fancy, you can find me there. Just shoot me a message.
Cool. We'll make sure to plug it in the notes. But Brian, it was a pleasure having you on the show, man. Super inspiring story for such a young guy. You're doing incredible things, building family, building a legacy, building properties, your empire. So kudos to you. And thanks for inspiring us today, man. Appreciate it.
Yeah. Be sure to stay in touch with you guys. I know we're talking back and forth on Instagram, so we'll continue that conversation.
Absolutely, man. We look forward to it.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.